All right, if you're prepping for your NISM Series 12 exam, you know Chapter 4 on secondary markets is a big one. So in this explainer, we're going to dive deep and break down everything you need to know, from the core functions to how a trade actually settles, to make sure you absolutely nail this section. Okay, so here's the game plan for this chapter. First up, we'll tackle the fundamental role of the secondary market. Then we'll meet all the key players involved. From there, we'll actually follow the life of a trade step by step. We'll get into the weeds of the T+1 settlement process, and then look at the super important risk management systems. And of course, we'll wrap it all up with a handy checklist of the most important things to remember for your exam. All right, let's start at the very beginning. Before we can get into all the nitty-gritty of trading, we have to answer a really basic question. Why do we even have a secondary market? What purpose does it serve in the grand scheme of things? So, what is this place really? Well, it's the marketplace, where all the action happens after a security has already made its debut in the primary market. Okay, now this is the key thing you've got to remember. When you buy a share of a company on the stock exchange, you're not giving your money to that company. You're buying that share from another investor who decided to sell. The money just moves from one investor's pocket to another's. The best way to think about it is like buying a used car. Your money goes to the previous owner, not to Ford or Maruti. This market is what makes those initial shares valuable in the first place, because it gives people a place to trade them. Now, don't think of these 5 things as separate items on a list. No, they're all woven together. It really all kicks off with liquidity. That's just the fancy word for how easily you can buy or sell something. Because there's so much trading, the market can figure out a fair price for security. We call that price discovery. And that price, it sends a powerful signal about the company, the industry, and hey, even the whole economy. Sometimes it even points out companies that are undervalued, which can lead to big changes in who's in charge. Okay, so we've got the why down pat. Now let's meet the who. Let's look at the entire cast of characters and the underlying infrastructure that makes every single trade possible. You've got to picture the market as this huge, complex ecosystem. You've got your big platforms, right? The BSE and NSE, where the trading happens. Then you've got the investors and the companies creating the supply and demand. In the middle, you have brokers helping everyone make their trades. And kind of like a referee watching over the whole game to make sure it's fair, you have the main regulator, SEBI. Okay, this is a big one. The clearing corporation has one of the most important jobs in the whole system. It's the ultimate guarantor. It literally steps into the middle of every trade, becoming the buyer to every seller and the seller to every buyer. What does that mean for you? It means you never have to worry about the person on the other side of your trade failing to pay up. This idea of a central counterparty is the absolute foundation of trust in our market. Just think of a depository as a bank for your stocks, but instead of cash, it holds all your shares and bonds electronically in what we call a DMAT account. So when a trade happens, the depository just zaps the shares from the seller's account to the buyer's account. It makes the whole process of transferring ownership totally seamless, fast, and secure. So we know the why and the who. Now let's really get into the how. We're literally going to follow a single trade from the second you hit buy all the way to its final execution on the stock exchange. So this is how it all works in today's super fast electronic world. You tell your broker you want to buy. Your order is instantly shot over to the exchange. The exchange's computer system then finds a matching sell order based on price and time. Once it finds a match, bam, the trade is confirmed. And then a legal record, the contract note, gets created. It all happens in the blink of an eye. Okay, pay attention here because this is a classic exam question. When you place a market order, you're basically telling the system, I don't care about the exact price, just get me into the stock right now. But with a limit order, you're saying, I will only buy if the price is this much or lower. So the trade-off is really clear. Market orders give you speed, but limit orders give you control over the price. Think of the contract note as the official legal receipt for your trade. And this isn't optional. Your broker has to send this to you within 24 hours. It lays out every single detail, the exact price you paid, how many shares you bought, and all the fees and taxes. It's your ultimate proof of the transaction. So, you've got your confirmation, the trade is done, right? Well, not quite. The job isn't finished yet. Now we have to get into the crucial backend process where the actual money and the securities change hands. This is what we call clearing and settlement. And India is actually a leader here. We're one of the first big markets in the world to fully move to a T+1 settlement cycle, which is a huge deal for efficiency. The idea is simple. T is the day you trade. T+1 just means the actual handover of money for shares has to be done by the very next business day. This makes the whole system faster and reduces a ton of risk. Let's just walk through it real quick. On the trading day, that's T, Your trade gets executed. The clearing corporation then figures out what everyone owes. Then, on T+1, the pay-in happens. Brokers who owe money pay up, and brokers who owe shares deliver them. Right after that comes the payout, where the clearing corporation gives that money and those shares to the brokers who are supposed to receive them. Simple as that. So, you might be wondering, with literally trillions of rupees flying around every day, what stops the whole thing from collapsing if something goes wrong? How does the system protect itself? Well, that's where risk management comes in. Margins are, without a doubt, the first line of defense. Before you even make a big trade, your broker takes a margin from you. Think of it like a security deposit. It's held by the clearing corporation, and it's there to make sure that if the market suddenly moves against you, there's already money set aside to cover any potential losses. It protects the whole system. Now, margin isn't just one simple fee. It's actually made up of a few different parts that work together. You've got the VAR margin, which covers your normal, everyday price swings. Then there's the extreme loss margin, which is for those really rare, wild market days. And finally, the mark-to-market margin settles up any paper losses or gains every single day so they don't get out of control. It's a really robust safety net. And then you have circuit breakers. These are basically the market's giant emergency brake. If things get too crazy, if the whole market suddenly plummets or shoots up by, say, 10%, bam, trading is automatically stopped. It forces everyone to just take a breath, absorb what's happening, and hopefully prevents a full-blown panic. All right, we've covered a ton of ground. Let's bring it all together. To finish up, here's a quick checklist of the absolute must-know stuff from this chapter, the things you are very likely to see on your NISM exam. All right, let's lock in these 3 key takeaways. First, the number one job of the secondary market is to provide liquidity. That's it. Second, the contract note is your official legal proof of a trade with all the details. And third, margins control risk by acting as a security deposit to prevent defaults. Nail these 3 points and you've got a fantastic grasp of this chapter. You're definitely on the right track for the exam.